Let's kick off now with Paul Rickard of the Switzer report and his Scaredy Cat Portfolio. Thanks for joining us, Paul.
Thanks, Peter.
Now, last week I kind of teased you to think about doing a portfolio called the Scaredy Cat Portfolio. Not that you're a scaredy cat, you're a fearless investor on the market, but being a banker, you've got the ability to control the risk factors around investing. And you've done that. You come good with the Scaredy Cat Portfolio.
Yeah, I do have 10 stocks for my Scaredy Cat portfolio, Pete.
Yeah.
I guess one of the questions is whether you should just go to cash if you're really scared. But we've gone for stocks because fund managers, institutions can't just go to cash. They've got too much money to manage.
Yep.
And even when the market does get scared, sometimes the so-called defensive scaredy cat stocks actually do okay.
Yeah.
And we've seen that even if you go back to what happened in April on Liberation Day.
Yeah.
Some of the scaredy cat stocks rose during that get down. Yeah.
So did you use that as a bit of your criteria?
A little bit, because I think it does show you where people will go to. But I've actually expanded a little bit because I wanted to get a little more representative across the 10 sectors.
Okay.
So it's not all one sector. So try to get some balance. 10's probably the minimum, but let's just go with that as a working size.
Would you, if someone actually was scared and they thought, gee, I must take Rickard's recommendations here, would you go 10%, 10%, 10% and equal weighted?
Look, probably, yeah. I mean, look, I probably
It's really trendy now, isn't it?
we'd probably have a few more stocks, to be honest.
Yeah,
But,
like 25%.
yeah, no, I mean, it's worthwhile what I haven't included. So I haven't got any so-called resource stocks,
Yeah.
bar gold.
I go.
That cuts out a fair bit of the market.
Yep.
And I've also gone for no energy company. Now, in a real scaredy cat situation, the price of oil could go up,
Yeah.
but it's so hard to predict.
If it's recession scaredy cat, they go down.
Recession scaredy cat will go down.
Yeah.
But so
scaredy cat is up.
yeah, so I haven't left. I've excluded energy stocks as well, and you can argue either way whether they go up or go down.
Okay.
Others are sort of, I think, if you got most likely scenarios for a scaredy cat is that it has a negative effect on the economy, and the economy slows, and probably interest rate plunge too.
Yeah.
Right? That's probably what should have worked.
Factored in that you probably get a decent dividend out of these 10.
Yeah, so all of them are income payers bar the gold stock. I think even Northern Star pays a little dividend. It does actually.
Yeah.
All are paying quite by market standards, a reasonable dividend.
Yeah, okay.
Not saying it's a big dividend, but there's certainly the dividends on the higher side.
Yeah, and as I was listening to you, and I know I've done some work in the past where I've looked at classic income stocks during the GFC, it was in particular, and they fell, but they fell by less and they rebounded quickly because it's like when you're scared, but you're getting a little more confident the market's going to rebound, you tend not to buy the tech stocks or the high growth. You buy the reliable ones. So the big four banks are bought out of a big downturn.
Yeah. A good example, Peter, a classic stock in that category is Telstra. So Telstra's always going to be in my Scaredy Cat portfolio.
Oh, yeah.
It's come after a big run up, much more than I thought. But but it is, it's an oligopoly or it's a huge market share. Number one is smart. Price leader.
Yeah.
Not a lot of pressure. Its earnings are actually growing a little bit, pays a good dividend.
Yeah.
It's very focused on Australia, telecommunications, recession, pretty immune. So if the world went to, I can't use that word.
Is a nice one.
Telstra's going to be as pretty old, reliable, and as boring, and it's paying a reasonable dividend. So
now, I did have a sneak preview with your book, and I noticed that CBA's in there, but now. Ordinarily, I would totally agree, but because CBA has been bid so much out of the park,
I still think it's the one that
it would fall less. Is that right?
fall less, and it's the first one the institutions will buy because look, every man his dog believes it's overpriced. So do I. We've been saying it for some
pretty smart dogs out there.
Very smart dogs, but it's also still it's a very clean bank in the sense that there's nothing else going on. It's very retail focused for its deposits.
Yeah.
Which gives it a cost of borrowing advantage. It's better placed in a technology sense. There's nothing foreign in it.
Yeah.
New Zealand's a little foreign, but anyhow, it's got it would be the one in a real crisis situation. The instos will still buy it first. So it might come down. You could probably, the other banks, there's just question marks. Right now, we've got currently a bit of a thing going on with the CEO.
Yeah.
ANZ, who I think is the other option, is the market is a bit out of favour on ANZ. And Westpac's a bit of an unknown quantity. because of new CEO, new strategy.
But it has been surprising on the
Has been surprising. So Westpac might be the other one I've thrown there, but I have put CBA. I just think that that's the one they'll go to first.
Okay,
Okay.
right. Okay, so CBA and Telstra, that's really scaredy cat
That's really
stuff.
scaredy cat
But
stuff.
quality scaredy.
Yeah.
All right, give us one that people might be surprised. Was there any?
Okay, so the one I put in there is probably the risk is Northern Star.
Yeah.
Now that's gold, and obviously gold is logical, right? So we've a market you don't expect, and
Yeah, gold price goes up.
yep.
A good company like this would benefit.
And interest rates falling helps gold, all right?
Yeah.
It actually helps gold.
Yeah.
It makes gold more attractive.
Yeah.
Now, so the question is, do you go for an ETF or something, or do you go for a miner?
Yeah.
I've actually gone for Northern Star because it's been pretty badly beaten down the last couple of months.
Yeah.
Look, I think we're actually seeing a chart there as I talk,
Yeah.
and you can see it's back to where it was about 9 months ago.
Yeah. It's a great company.
It is Australia's biggest producer now. Newmont used to be in that category. It's now, Newcrest is now owned by Newmont. You can still buy Newmont, but you're buying a lot of other Canadian miners in that category. So Northern Star is still the biggest. It's been pretty badly beaten up. So, higher production costs, slightly not miss on production itself, and then more capex. But I still think that's the one to go for. So that's the riskiest stock, I would say, but not. But you could play gold through just a gold ETF or something.
Yeah, okay. And have you actually gone for gold in your Scaredy Cat portfolio?
No, I haven't. No,
So Northern Star is your
would
gold.
only go gold, GLD, but I've gone for Northern Star because I think it's been so badly beaten up for what's been going on.
All right, so
a couple of other surprising ones.
Yeah.
Well, one we talked about last week, which is Amcor. Nice dividend payer. It's Amcor's plastics and packaging, huge in the US, not much now in Australia these days. It's a US company. So that probably helps. It's got an acquisition that it's made in the US, which I think is actually going to work for it.
Yeah.
Now, if you get Trump goes crazy, global economies go into recession, some of the demand, it will have a little bit of a volume impact. I mean, packaging is still susceptible consumer demand, although a lot of it is medical and other equipment that's fairly immune. So, but it is a good dividend payer, and for a US company, and
if tariffs lead to more manufacturing in the US, that should be good for them.
it's probably favored by that sort of scaredy cat situation. So I wanted to get something in, not just your typical, Telstra's bank, so something a little bit different.
Well, you got Coles in there, but not Woolworths.
I thought long and hard about Coles versus Woolworths. The
big change.
Yeah,
You've been an anti-Coles man.
I've been an anti-Coles man. I still think that Woolworths is still suffering a little bit.
Post-Banducci.
It's going to take a couple of years to turn that around. Coles is actually still making market share gains. It is a better dividend payer. And on a price earnings basis, it's still a little bit cheaper than Woolworths.
Where do you shop? Where do you shop?
I shop at Woolworths, but Woolworths has a couple other problems. First of all, it's got Big W, which is sort of a disaster. So it's all burning cash at Big W. Doesn't know what to do with that.
My puffy jacket came from Big W, so it's a ripper.
It's getting thrashed by Kmart and Target, as I call it, rather than well, Target.
People call it Target.
Yeah. So and it's also that's one of the Woolworths in New Zealand. They can't seem to make it to New Zealand division fire. Kmart's got its own little challenge with its food and drinks part of the
Dan Murphy's?
Not Dan Murphy's, but BWS, liquor, Liquorland, all those sorts of
those brands, yeah. But Dan Murphy's kills them, doesn't it?
Dan Murphy's kills them. And look, their problem is just that the liquor is very flat as a commodity, right?
Young people.
People who don't drink it.
Threats to the industry.
So look, I've gone for Coles. Look, there's not much in it. You could put Woolworths in it. Okay, so that's your supermarket.
Now, Luke's got put the on the screen. Red is Woolworths and Coles is blue. So you can see that they have been outperforming.
Yeah, I will be switching back to Woolworths at some stage. I have
sort of a buying opportunity.
But it's more when Coles gets too expensive. But I think it's just a little bit still a little bit in the Coles thing. But I could go Woolworths. Okay, let's go for some others in that sort of a couple more financials. I've tried to minimise the financials, but they're in different parts. Medibank.
Yeah.
Private health insurance, it's pretty consumer immune. Now, there are long-term trends against private health insurance, but
Yeah.
that's not going to be impacted by a crazy man in the White House.
No.
And they're making good gains in terms of market share and also adjacencies, and they're getting better returns, margins going up. So that's Medibank. Suncorp's my insurer, Pete. Now,
Used to be a bank, it's no longer a bank.
it's now just an insurer, and it's all very domestic. Now, that's probably more got bigger climate risks and natural hazard risks than it does a political or a thing, right? What have we talked about? Northern Star, APA, which of course is the pipeline
business,
yep. Regulated. A little bit of a utility play, you could say, but it will benefit from, again, interest rates coming down for that. It would be really good.
Yeah.
So,
So explain why, Paul.
yeah, because it's pretty leveraged, Peter. It runs, it's essentially very regulated assets. And so when I say regulated assets, a lot of its assets are gas pipelines. And the volume of gas it can for example, the Moomba to Sydney gas pipeline, I'm sure, is one of APA's pipeline assets and owns, right? So basically, it runs at full capacity because they can't increase anymore. What is allowed to charge the gas distribution companies is regulated by, there's a bit like the ACCC, there's a regulator who says what they can charge. It's sort of like the operating costs are really low. Once you build the pipeline, it just flows, right?
Yeah.
Got to pump it at a couple of ends, right? And so against that, it's got a fair bit of debt. So it's paying quite big interest costs.
Yeah, it's good for
Yeah, basically guaranteed income, guaranteed debt. It wins longer term when rates come down, not in the short term per se.
Yeah.
Also means there's less risk of having to borrow capital issue.
Yeah.
It's also owns some electricity assets. It's now owns some solar and some wind and some other things. So that's, again, fairly regulated in terms of what they're able to charge to.
Okay. Now, hang on. There's an interesting one in there. People will be Sonic.
Yeah, so that's probably a little bit of the exception. Sonic Healthcare. Now, I wanted to spread most of the sectors, so that was one of my constraints. And Sonic is probably the one I think is the safest within sort of the leading health plays.
Why?
So Sonic is global pathology, right? It's about 40% in the US and Canada, 30% Europe, and 30% Australia.
Yeah.
Now, pathology services aren't very susceptible to economic conditions, right?
Yeah. Sick people need pathology.
Right.
Yeah.
So it's basically, its revenue is pretty stable, very predictable. It's been working hard on its margin. Now, Sonic, all these pathology companies did super well out of COVID. They had troubles adjusting post-COVID because they took on a lot of extra costs, but they got paid a fortune in COVID to do all the testing. They made a squillion in COVID, but they took on a lot of extra costs. So they've had to work hard to actually, on lower volumes, readjust their cost base. Sonic is so it was a $40 stock in COVID. It's now trades from about $26 and $28.
Yeah.
Come down a long way. Pays a bit of a dividend, which is a little bit of franking coming into Sonic. And you can see the chart there. It's been pretty stable, right?
Yeah. We're poor old CSL's gone down in line. Is starting to come back.
It's not going to be impacted by anything in the pharmaceutical space. So, and you can see even after
Trump punishment.
No Trump punishment. Came off a little bit like everything in the Liberation Day, but they didn't sell it too hard and not much has happened. So Sonic's the one.
Yep.
I mentioned Amcor. Transurban's another, Pete. In the industrial space, although it's a toll road company, again, same sort of thinking. A little bit of guaranteed income in terms of CPI. It will, in a slower economy, a recession here, there'll be a little bit less traffic.
But they go to golf. They lose their job. They go to golf.
Maybe a few less trucks, but then again, if interest rates fall, Transurban is another company that's basically, again, it's very capital intensive.
It pays with term deposits.
It pays with term deposits. So interest rates coming down won't affect the profit in the short term, but it's good medium term for it. So
one thing you've left out, Paul, are REITs. But what happens to REITs?
Yeah, look, I left some REITs out. The REITs, it's a tough one, Pete. I sort of think REITs, probably in a recession, you do all right.
Because rates come down.
Rates come down, and with so-called capitalisation rates come down to value them.
Right.
So yeah, I mean that's probably some good thinking. You know, I always sort of put the REITs to one side when I think stocks a little bit, but
Yeah.
I could have had a little. I could have
Yeah.
put a couple of
If
REITs.
you'd gone for 20, it would
Yep.
have been a REIT in
Yep.
there. Yeah. Okay. Well, that's a really good collection of stocks. Of course, if you want to know the analysis behind that, you'd have to be a subscriber to the Switzer Report. And that's Paul, where Paul stars each week writing for the Switzer Report. Paul, thanks for joining us.